In recent weeks, the U.S. equity markets have experienced significant turbulence, leaving investors and analysts alike trying to make sense of the rapid shifts. Amidst this volatility, one of the most notable indicators has been the spike in the Volatility Index, VIX, which measures market fear and uncertainty. On a Monday not long ago, the VIX surged to 60, marking its third highest reading in history and reflecting widespread anxiety across the market. Furthermore, the VIX futures curve inverted, showing its steepest inversion since the pre-pandemic period. This drastic move in the VIX indicated that investors were bracing for more uncertainty and potential market declines. However, according to Tom Lee, co-founder of Fundstrat Global Advisors, the worst of the panic may already be behind us. Lee, a seasoned market strategist known for his careful analysis, has a more optimistic outlook than many of his peers. While acknowledging the recent spikes in volatility, he believes the U.S. equity markets are stabilizing, suggesting that the sharp sell-offs and fear-driven trading may be subsiding. In particular, Lee points to the VIX gradually returning to below 20 and the VIX futures curve returning to normal as signs that the market's panic phase is easing. Although there are still concerns, such as geopolitical risks and the unwinding of risky financial trades like the yen carry trade, Lee contends that the selling pressure has likely peaked. Navigating the ever-changing landscape of the U.S. equity markets is a challenge, especially after the intense volatility seen in recent weeks. However, Tom Lee's perspective offers an insightful roadmap for investors, emphasizing a balanced view rather than succumbing to market panic. As Lee has pointed out, the past week was a roller coaster ride for U.S. equities, with sharp declines followed by cautious recoveries. Investors nervously awaited critical inflation data, while major indices such as the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite saw significant swings, indicating a market still grappling with broader economic concerns. The dramatic rise in the VIX was perhaps the most striking indicator of the recent market turmoil. Often called Wall Street's fear gauge, the VIX spiked to levels rarely seen, signaling a heightened sense of anxiety among market participants. Historically, such spikes suggest that volatility could persist for some time as investors process weaker than expected economic data and the potential for a shift in the Federal Reserve's monetary policy. Yet, despite the alarming VIX readings, Lee's analysis offers a different narrative. Instead of focusing on the doom and gloom that often accompanies such market swings, Lee suggests that the recent VIX spike might actually represent the peak of market fear, rather than a precursor to further declines. As the VIX stabilizes and moves back toward 20, and as the steep inversion of the VIX futures curve begins to normalize, Lee posits that the worst of the market selling pressures may be behind us. This perspective is grounded in the idea that while the market is undoubtedly experiencing stress, it may have already priced in much of the bad news. According to Lee, the key takeaway for investors is that while the market remains volatile,
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month, but this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Right. So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation, it's now growth. So growth will continue pretty good, jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes, I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
the extreme fear that characterized the recent sell-off may have peaked, creating the potential for a recovery. In other words, the market may be nearing a bottom rather than facing the onset of a prolonged downturn. A central factor in Lee's outlook is the role of the Federal Reserve.
There's so many arguments that the probability of a double-digit gain in 2023 is far higher than people expect. But I think it does start with inflation and the Fed, because people talk about monetary policy lags, which is true, but it affects both inflation and the economy. Inflation has already fallen by half in just the past few months and is annualizing at 4%. This is before we've really seen the bite of the monetary hikes. On top of that, earnings could do better next year than expected because things like the PMI, the dollar, and supply chains are actually supports for earnings next year. And I think that maybe the most important thing to consider is two other things. One is that it's rare for stocks to have back-to-back declines.
The Fed's actions, or in some cases, its inaction, are a constant source of speculation in the markets. While some market observers have called for aggressive interest rate cuts or other drastic measures to stabilize the economy, Lee advocates for a more measured approach. He believes that the Fed's current data-dependent stance is essential for maintaining long-term market stability, even if it frustrates those looking for immediate action. Lee argues that the Fed should not react impulsively to short-term market movements, such as the recent VIX spike. Instead, he believes the Fed should continue to assess incoming data before making any significant policy shifts. This cautious approach, Lee contends, is critical to ensuring that the economy remains on a stable footing, particularly as the market braces for upcoming economic reports, including the July Producer Price Index, PPI, Consumer Price Index, CPI, and retail sales data. These figures will be crucial in determining whether inflationary pressures, which have spooked the markets, are beginning to ease. If inflation does show signs of stabilizing, it could reinforce Lee's thesis that the worst of the market's turmoil is over. Conversely, persistently high inflation could reignite fears of more aggressive action from the Federal Reserve, potentially leading to further volatility. The stakes are high, and investors will be watching these data points closely to gauge the direction of the economy and the Fed's next moves. Beyond inflation and monetary policy, Lee also examines other key economic indicators, particularly in the labor market. Despite concerns about a potential economic slowdown, Lee sees encouraging signs in recent jobless claims data. For example, he points to a surprising drop in weekly jobless claims from Texas as evidence that the U.S. economy may be more resilient than many fear. If this trend continues, it could provide a much-needed boost to market sentiment, alleviating some of the current anxiety. Lee also addresses the fear of a growth scare that has been exacerbated by weaker-than-expected data from the manufacturing and employment sectors.
I think it is the former that you described. We have over 3 days, suddenly markets reverse and Japan down over 20%. And as you're pointing out, the NASDAQ could even, decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, meaning like, do markets seize up? But with interest rates falling, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that today's the bottom.
Scare.
While the market has reacted negatively to these reports, Lee suggests that the recent dip may ultimately be seen as a temporary scare, rather than the beginning of a more severe downturn. For investors who are unsure whether to cut their losses or stay the course, Lee's message is clear. While the market may face additional challenges, the underlying economy may be more robust than it appears. One area of the market that Lee believes warrants special attention is the so-called yen carry trade, a complex financial strategy in which investors borrow in yen at low interest rates to invest in higher-yielding assets elsewhere. This trade, which has become increasingly popular among institutional investors, carries significant risks. Lee notes that the unwinding of this trade, particularly in response to recent market volatility, could create ripple effects. However, he also points out that if the trade unwinds in an orderly manner, it should not be disruptive to the broader market. In addition to his short-term market outlook, Lee also takes a longer-term view, considering the broader economic context. He acknowledges that there are still risks on the horizon, particularly geopolitical risks and lingering uncertainties related to global trade and supply chains. However, Lee argues that these factors, while significant, are not insurmountable. In his view, the market's current state reflects a combination of fear and uncertainty rather than a fundamental breakdown in the economy. This distinction is crucial, as it suggests that once the immediate concerns subside, the market could regain its footing. Lee's analysis implies that the recent market turbulence may be more of a temporary setback than a lasting crisis. For long-term investors, this presents an opportunity to take advantage of potential market mispricing and position themselves for future gains. Another area where Lee's optimism shines through is in his outlook for the retail sector. With major companies like Home Depot and Walmart set to report earnings, these results will offer valuable insights into consumer spending.
Are sort of confused. I think that's what the next 8 weeks are going to be like into Election Day. I think it's a very challenging period because no one can have conviction until they really know who's in the White House. But there are some positive sort of supports coming into play, and next week is the Fed meeting. We know the Fed is going to make some cuts, and with the inflation data being supportive and the labor markets needing some support, I think it's going to give the markets some confidence. So I think we do kind of trade well into that meeting and maybe even the week or two after.
Does the market need a 50 basis point cut to stay within that 5,300 to 5,700 range that you think we're going to bounce around in?
You know, I think that a 25 or 50 has both hawkish or dovish implications.
Right.
So I think it's ultimately whether Fed Chair Powell comes across as this is the start of a cycle where they're confident that we're moving back towards neutral. And whatever number they make is actually quite dovish and positive. But if it seems like this is dragging along the FOMC members, and then there's even concerns about a hard landing, then I think the market can view anything they do as negative. I think it's going to come out positive, though.
A critical component of the U.S. economy. Despite recent concerns about a slowdown in the job market, Lee argues that consumer health remains relatively strong, as evidenced by the lack of alarming details in the spending data so far. If upcoming earnings reports from retailers show strong consumer demand, it could help dispel some of the fears driving market volatility. On the other hand, disappointing earnings could reinforce the narrative of an impending economic slowdown and contribute to further market instability. Either way, Lee believes that the retail sector will be a critical area to watch in the coming weeks as investors look for clues about the broader economic outlook. While Lee's analysis is generally optimistic, he is not without his caveats. He acknowledges that the market is still in a fragile state and that any number of factors, whether geopolitical, economic, or related to the Fed's actions, could tip the scales back toward volatility. However, his overall message is one of cautious optimism. While the market's recent turbulence is unsettling, it does not necessarily signal the beginning of a prolonged downturn. This perspective is valuable for investors who may be struggling to make sense of the current market environment. Lee's analysis provides a framework for understanding the recent volatility as part of a broader cycle rather than as a one-off event. By focusing on underlying economic fundamentals, Lee offers a more balanced view that contrasts with the often pessimistic narratives that dominate financial news cycles. As the market continues to digest the latest data and adjust to the Fed's evolving stance, Lee's insights will be critical in shaping investor expectations. His emphasis on the importance of a forward-looking approach, combined with a recognition of the market's inherent resilience, offers a roadmap for navigating these uncertain times. In the weeks and months ahead, the market's direction will likely be influenced by a complex interplay of factors, including inflation data, Fed policy decisions, and global events. Ultimately, Tom Lee's perspective serves as a reminder that market volatility, while unsettling, is not necessarily a sign of impending doom. By staying focused on the bigger picture and remaining attuned to underlying economic trends, investors can navigate these choppy waters with confidence. Lee's analysis, grounded in data and tempered by experience, provides a valuable counterpoint to the more alarmist narratives that often dominate financial discourse. In conclusion, While the road ahead may be bumpy, Lee's analysis suggests that the worst of the market's turbulence may be behind us. For investors willing to take a long-term view, this period of volatility could present opportunities to capitalize on the market's eventual recovery. If you enjoyed this, don't forget to like, comment, and subscribe. Your support means the world, and it helps us keep bringing you more great content. Plus, I'd love to hear your thoughts. Drop a comment below.